Hey, what's going on everyone? This is part 2 of exercise 17.16. So previous video was part 1 where we looked at A through to D, I believe it was D, where we finished on the budgeted income statement. So we looked at all the information, we reconstructed some accounts, and we built from there. Now keep in mind, we are reconstructing accounts here when we do calculate these expenses. It may not look it, but we are. So just a heads up there. So we're going to start off with, I'm just going to bring up the textbook so you can see we've got the information we've been provided, the debits, credits. Now this is sort of an extract, it hasn't fully been accounted for yet. So like that photocopier rent, that's changed, so that's going to change. So that's where we're at, okay? That's where we're at. That's what we've got to work with. We just roll with it. So we see we've got all the key information, but we're just going to flip ahead quickly to E. Explain how the preparation of budget income statement could assist with planning to achieve improved gross profit. So a theory question. We've got F, where we're using the information on these dot points and here to create the current and non-current assets part of the balance sheet. Don't need to do a full balance sheet, thankfully. And Poppy has received advice that the $3,000 advertising campaign would mean sales would be higher. That's good English than originally budgeted, and we've got to do another budgeted income statement. Now, I'm not going to retype the whole thing. I'm just going to copy and paste it across, and I'm just going to make the adjustments for the numbers. So I'll do that at the end. But let's tick over to E, I think. E is probably where we're going to tick over to. So E, explain how the preparation of the budgeted income statement, budget income statement could assist with planning to achieve improved gross profit. By the way, if you forgot, we are on page 477 on our textbook, 441 on our exercise book. Alright, E. So the preparation, try and use the same language in the question, of a budgeted income statement could assist with planning to achieve an improved gross profit by checking / modeling the cost of the markup to find an acceptable gross profit. This will help the business in determining if markup percentage should increase or potentially they are paying too much for inventory. So it's just those little considerations. So it's acknowledging that, oh, hey, this is how we calculate our gross profit. It's by determining the cost of sales. You could even talk about the sales amount, which I sort of did here, but you could also apply the returns as our quality good that we lower returns. So you've got a few options there, but essentially you're playing with everything above this gross profit line. That's how you sort of got to treat it. So if they say, determining net profit, you can sort of play with everything above the net profit line. If it just says gross profit, play with the gross profit line. Now, they did say gross profit. They didn't say adjusted gross profit. I think safest bet, don't play here, play up here. Just play it safe is what I'm trying to say, okay? Alright, let's tick over to F. Prepare an extract of the budgeted balance sheet of Digital Masters as at the 30th of June 2026. It shows current non-current assets. So let's go through the starting amount. So we've got accounts receivable. Let's do accounts receivable. So we know accounts receivable also comes with less allowance for doubtful debts. Now, so we go accounts receivable. What's our accounts receivable amount? We have a look. We see dot point one, last line, last bit, or second sentence. Accounts receivable as at the 30th of June 2026 are expected to be 19,000. That's good enough for me. And then less allowance for doubtful debt. Less allowance for doubtful debt we actually calculated up here in C. And the reason I calculated the 1710, and I'll read the comment again. I'll read it again. Hold on, it's one of the dot points. It is a dot point. I saw a dot point about it. It's annoying, I can't find it now. Oh yeah, here it is. Other estimates include doubtful debts, 1% of net credit sales. So doubtful debts is this allowance. So it's got to be 1% of the net credit sales. So net credit sales will be 180,000, dot point one, minus the returns 5%, which is 5%. That's in the dot point three. That gives you that number, 171,000.1, because it's 1%, will give you 1710. And that's what the balance needs to be. So we needed to get it to 1710, started the month at 800, so that's why the expense is 910. The total amount needs to be 1710. That's a bit of account reconstruction there as well. I just showed you a bit of a convoluted way of getting there. So let's chuck our numbers in. Let's get our calculator up and running. 17290. 17290. Don't forget, balance sheet, brackets, huzzah. And then we just got to put in the rest of the amount. So we've got all inventories purchased at a 50% markup. Not really relevant. Other estimates, you got purchase of inventory not helping. Sales, discount expense, wage expense. Depreciation of shop fittings will be in the non-current assets, so I'll come back to that at the end. We've got cash drawings, isn't relevant. Inventory loss, doubtful debt, not relevant at all. We've already done the doubtful debt anyway. So next one, Poppy is currently renting a photocopier at $500 per month, payable 12 months in advance, and then it increases to $600. So let's go prepaid photocopier. Prepaid photocopy rent. Now we need to calculate this amount. So how do we get it? Let's go back to the photocopy expense. Now we see we pay 12 months in advance. So every 1st of September we pay the new amount. Now it's gone up to $600 per month. So that means we've got 12 months of $600. We've only used 10 of those 12. 2 months must be remaining. 2 times 600 is 1,200. So let's just put a little bit of a working out column there. So the logic behind that is 600 per month, paid 12 months in advance, used 10 months, 2 months remaining, 2 times 600 gives us 1,200. That's all the logic behind that one. We've got estimates, estimated bank balances. You've got inventory. We're just going to put that straight in. Inventory 106780. And I believe that's everything. I don't believe there's anything else. But I'd be wrong. Here's where I'm wrong. If we go back to the term deposits, let's go back up to the term deposit. On the 1st of April, the business will invest $6,000 in a 3-year term deposit. Interest is earned at 8% per annum, payable on 31st of March each year. So from April to May to June, they earned revenue, but they haven't received it. So that's an asset. accrued interest revenue. Because they've earned it, they haven't received it. So that's an asset, because it's a benefit we get later. And it should be the amount we previously calculated. So let's have a look. Interest revenue, $120. Now, the reason this is messy is because this probably needs a third column. So I'm going to add that third column just while we talk. Just going to add that third column just while we talk. So the third column really tidies this up. And then we can provide a subtotal here, because you can see that less, and then we just got our normal totals and across here. But if you're in a exam and there's only two, just underneath there, and just make a mark so you know that, hey, I include this number, okay? Just, that's a little pro tip just to help you out. And then we just move that up one. So then we get our subtotals. Enough about formatting. Let's go 1729 plus, what did I do? No, 17290 plus 1200 plus 16780 plus 120 is 125390. Okay, for whatever reason, that just went that way. Sure, why not? Why not? 125390. So there's our current assets, 125390. Now we need to do the non-current assets, and it's much the same, where if we have a look at our textbook, we see that shop fittings was on there. So we go shop fittings. Shop fittings less accumulated depreciation. And the number is already given there for shop fittings because they didn't buy anymore, so that asset amount stays the same. Now you've got the less accumulated depreciation. Thing is with that though, it's easy to just go 2160. Really easy to do that, but you've got to add in the year that just happened. So it becomes 21600 plus 5300. So that's where that needs to come in. Now you don't need the brackets here. I mean, you can put the brackets. I'm not a fan of brackets in balance sheets personally, but if you want to, you can, I guess. I don't like it, so I wouldn't. Less accumulated depreciation. Let's put it as shop fittings. Now, I know it's not really a big issue because we've only got one non-current asset, but if you have multiple, you probably do want to make that distinction. Anyway, we got 21600. What was our other one? You can see plus 5300. 26900. That becomes 2699, not 3, 900, and then we go 48,000 minus 26900, 21,100. Boom. Why is that? Oh, it's because it created the new thing. All right. Then we've got the other one, which is the term deposit, and that's just $6,000. Term deposits essentially are you give the bank money, you get it back eventually, but they give you interest because then they can use that money to do what they need to do. So it's like you're giving the bank a loan in layman's terms. Hold on. Yeah, I thought that was 100. Yeah, it's 21,100, 100, and then we just got to add up our assets. So that's why term deposit is a non-current asset until that last year, 125,390. You don't get any extra money, you just earn interest on it. 152490 is our answer. 152490. So that's F. So a bit of logic behind that, but it's just those little numbers. Make sure you add in the depreciation that just happened. Alright, G. So what I'm going to do with G is I'm literally just going to copy the whole thing across. We're just going to copy it all across before we do anything else. What? Ah, yes, because they added another square, right. Alright, cool. So those are the numbers that we've done previously. I'm just going to leave those there because that's going to be important later. So, if we go back to our textbook, we have a look at G. We prepare a budget income statement to model the effect of the advertising campaign. So, they received advice if they did the advertising campaign, it will be 5% higher sales than originally budgeted. So we need to increase the 5%. So that means we need to do these. We need to change, we need to change these two. We need to change this. Obviously that's going to change. Cost of sales will change. Inventory loss will change. Interest revenue stays the same. Bad debt will change because that's impacted by sales. Stays the same. Expense, see how it says by sales, that changes. Wages stay the same. Depreciation stays the same. So anything with italics changes. So let's put those numbers in again. So we got 5% higher sales. Let's start with the cash. Let's start with the credit. So two ways of doing this, and I'll use the 42,000 to start. So 5% sales could be 42,000 multiplied by 0.05 gives us a 2,100 increase, which when we re-add the amount in is 42,44100. Or we could go the other route and go 42,000 multiplied by 1. Okay, I won't be doing that. 42,000 multiplied by 1.05, 44,100, because 42,000 is the 100% we're on at the moment. That 5% increase means we just add 0.5 on. If we want, it's like when we get GST, we just go the base amount times 1.1 to get including GST. Same concept, okay? So that becomes 44,100. And actually, I'm gonna keep anything I changed. I'm gonna keep in italics, okay? And then we do the same for credit sales. 180,000 multiplied by 0.05. Wait, why am I doing it the hard way? 1.05, 18900. So 189. There we go. New amount. So 44100 plus 18900. 233,100. 233,100. Now this. Now we got sales returns. So if we have a look at sales returns was 5% of net credit sales, so it becomes 189,000 multiplied by 0.05, 9450. So that becomes 9450. Let's redo those numbers again. 233,100 minus 9450, 223,650. And then this just stays the same. It just becomes 223,650 and instead of 213. let's put our numbers there. Divide by 2. Yep, divide by 2. 1 1 1 1 1. Wait, words. Let's try those words again. What is? Sorry, bit of a problem. Yeah. Sorry, I'm just trying to get stuff to load through. 11825. 223650. Divide by 2. 111825. There we go. 11825. 118. Yep, 11825. There we go. Got that nice and simple. And that's because the cost of sales still stays the same. Alright, then we go into here, we see that still stays the same. Now, inventory loss. Inventory loss, if we remember, 1% of sales, so it's just 1% of sales. We go 223 100. Wait. Whoops. 233 100. There we go. Minus. Times. There we go. Times 0.01. 2331 would be our amount. 2331. And it'd help if I put it in the right amount. And then it's just, let's readjust all these numbers. So 111825 minus 2331 gives us 109494. 109494. Then you plus 120 into that, it becomes, there we go. We add the 120, 109614. I'll just double check that though. Plus 120, yep, 109614. Perfect. So that's our new amount. So we got to do the discount expense. We got to do the bad debt expense. So we'll do the discount expense. So instead of, we got to put in the new credit sales amount, which is 189000. 2% of that, 0.02, 3780. Oh. Okay, 3780. Let me just delete. Cool. That's our new number. That should be 189. Let's at least keep our comments consistent. There we go. And the last number we need to do is the bad debt expense. So we need to calculate very similar to what we did above for here. And so it is net credit sales. So let's get our net credit sales up. So let's go. Net credit sales will be, and we just go up, we go 189000 minus 9450. That'll give us, where are we? 189000 minus 9450. 179550. 179550. Net credit sales multiplied by 0.05, I believe. 0.01, sorry. Doubtful debt is 0.01. Will give us 179550 multiplied by 0.01, and that'll give us the amount the bad doubtful debt should be at the end. Which will be, you can see, 1795.5. We're going to round up 1795.5, round up. We're going to round up 1796. There we go. Now, we always round up because it's not like we kept it to 1795. Actually, no, it was a little bit higher. Just a heads up there, minus 800 from start, and you have bad debt expense. So minus that, it'll be 896 will be our new bad debt amount. So that should be, oh sorry, yeah, my 996, my mistake, 996, because 1795 or 1796, 1796 minus 800, it'll be 996. Make sure to round up. No, sorry. 96, there we go. That's how that needs to look. And then we just re-add our numbers again. So let's just re-add the numbers, 996 plus 7,000 plus 3780 plus 29000 plus 5300 will give us 46076. But there is one number I have missed. So if we read the textbook, we go, the advertising campaign is $3,000. So I got to pay that. Advertising is an expense we need to add in. So we get our original number and we go plus 3,000 gives us 49076. So we'll just move that number down and we'll go 49076. And then we just need to go the 190614 minus 49076, and that becomes 60,538. And so when you're thinking about that, you go, is that worth it? And that's where that consideration and that whole argument comes in. So it'll be 60,538. So thank you for following along. These are challenging exercises, but just read, practice, and you will get there. So on that note, stay safe, look after yourself, and I will see you soon.